Okay. I want to record a couple of concepts. I'm going to go through the concepts that I have over here. We're going to do a very quick review. Okay. First of all, we spoke about the circular flow diagram. And the circular flow diagram basically said it's a way of describing the economy where you have households versus firms, okay? And you have the factor market, which is the labor market, and the goods market, okay? So we said, well, the households provide, they buy stuff from the goods market, okay? And the firms buy the services of the workers in the factor market, okay? And so in other words, the firms hire workers and they pay the households, okay? And the households buy the goods and that money goes to the firms. So this is how the money flows in the economy, okay? We can add more to this system, right? So we can, for example, include government over here, right? So we say, well, the government buys stuff from the goods market. Where does the government get its money from? From households' taxes. And the government returns some of that money back in transfers. That's transfer payments like unemployment compensation, right? Also, we know that companies also buy stuff from the goods market. That's the investments. When companies buy stuff in order to produce more stuff with it, that's investments, okay? And where do the firms get the money in order to buy the goods, okay? So typically the firms get it from the financial sector. So in other words, that's where the firms get the money in order to buy stuff. And where does the financial sector get its money from? The financial sector gets its money from households. Okay, so in other words, households can save money in the financial sector or they can spend it in the goods market. Okay, then you have the foreign sector. Okay, we can include it or we cannot, but the point is that the circular flow diagram basically tells me how the money is flowing in this economy. Okay, all right, that was the first concept. I wanted to also define disposable income is income after you've paid your taxes and received whatever transfers you did from the government. Okay? Keep in mind, in the back of your mind, we're saying we have demand for goods. Because people demand goods, the firms produce the goods. In order to produce them, they have to use workers, and that creates income. And that income ends up in people's pockets, and that's what fuels demand again. So that's basically another way of doing the circular flow diagram. Okay? Okay. We said, keeping in mind this idea, right, that we have demand for goods, so the amount that people buy of all the value that people purchase, okay, is equal to the value that is produced, which is equal to the income produced. Okay, so in equilibrium, these three have to be equal. Okay, so demand, who's buying stuff? Well, we have consumers, we call that consumption. We have businesses, that's investment. So investment is any kind of purchase not for its own sake, but in order to make more money with it. So for example, if I'm buying a computer for myself, that's a consumption item. If I'm buying it in order to use it for my business, that's an investment item. Okay? So usually investment is attributed to firms and consumption to households. The government also buys goods. So who's buying all the goods? Consumers, businesses, the government. And then we have exports minus imports, okay, which is net exports, okay, because foreigners are buying our stuff. Why do we have to subtract imports? Because the total amount that people consume is not just American-made goods, it's also foreign goods. So this includes foreign goods. This also includes foreign goods. Government also spends money on foreign goods. So if we want the demand to be the demand for American-made stuff, we have to subtract whatever consumers buy, businesses buy, government buys from foreigners. So that's why we have to subtract imports, okay? And what we end up with is the demand for American-made goods, which has to equal in equilibrium to the supply of American-made goods, okay? Inventories. We said if you produce something this year and you don't sell it, it's considered inventory. It's what's sitting on the shelf, okay? It's the product that's sitting on the shelf. That is considered part of investment, okay? The idea being that since we're saying the total amount that people purchase has to equal to the amount that people produce in 1 year, okay? So let's say you produced $1,000 worth of stuff, but you only sold $500 worth of stuff. So then this wouldn't be inequality, right? So how do we fix that? So that's why we add to the demand side whatever inventory, whatever didn't sell, is considered part of investment. So that once you put in whatever didn't sell as part of investment, then demand is equal to supply. Okay. Intermediate versus final goods. We said, how do we measure gross domestic product, right? There's multiple ways to measure it. We can go to the IRS and find people's income, okay? And income would be wages, salaries, profits, right? Because it's income to everybody in the economy, rents, and interest payments. Okay, so these things, you can add them up and you get income, okay? You could go to spending surveys. You can ask people how much they bought. You can ask businesses how much they bought, the government how much they bought. So in other words, you can have expenditure surveys and figure out the demand side. Or you can go to businesses and ask them how much they produced. Now, when you do that, okay, one approach is to only count final goods, meaning the goods, the value of the goods when they reach the consumer. Alternatively, we can count the value added, which is for each sector, take the value of sales and subtract from it intermediate goods. Intermediate goods is the value of any inputs that you put in. Okay? The reason that we have these two separate approaches, with the final goods approach, we're worried that if I count for every sector of the economy how much they produced, some sectors are being used as inputs in other sectors. So, for example, if I find out that the value of flour produced is $100, okay, and the value of sugar produced is $100, and both flour and sugar are sold to the bakery, and the bakery makes cakes, and the cakes are worth $500. So the problem is this $500 that the bakery produces, it includes the value of the sugar and the flour. So if I count the flour, the sugar, the cakes, I'm double counting the value of the flour and the sugar. So the final goods approach basically says, you know what, only count goods when they're in their final state, when they're reaching the consumer, okay? The value added approach says, no, you know what, every sector, you say, well, how much did you sell? So in this case, flour, 100, minus what did you begin with? Okay, maybe you began with the wheat. So how much value did you add? The sugar, how much did you sell? $100. What did you begin with? Okay, so how much value did you add? And in the case of cakes here, for example, you sold $500, you subtract from it the value of the intermediate goods, so you added $300 worth of value. Okay? Whether you compute GDP through the final goods approach or the value added approach, or you add up total demand, or you add up income, you should get the same number. Okay. Okay, what's in and out of GDP? So we said GDP is gross domestic product, which is the value, it's the sum of the value of all final goods and services produced in the domestic economy this year. Okay? So, if you're using the final goods approach, you're only counting final goods, sum of value. So for each sector, you're multiplying the quantity they produce by the price. Okay? We're counting both goods and services. Okay, so for example, a haircut is a service, a good is like a refrigerator, right? You're only counting what's produced this year. Okay, so if it's a used good that I just resold, the value of the used good doesn't go into GDP, just the salesman's service would be included. In the domestic economy, we're only interested in what's happening in U.S. soil. This year, because the GDP is being counted annually. Well, it's counted every 3 months, quarterly in other words, but we also count it per year. Okay? So if, for example, I spend money on foreign wine, okay, the value of foreign wine is not part of GDP because it wasn't produced domestically. Okay? What else? Well, I guess that's it. I mean, we did a bunch of examples. You can look at the quizzes that we have online. Okay. Nominal versus real GDP. Okay, so nominal GDP, since we have to add up the value, so for example, let's say we have bread and cheese in this economy. Okay, so you have 2 years. You have 2000 and 2001. Okay, so you got price, quantity, okay? So let's say bread was $1, cheese was $2, and you had 10 units of each. Okay, so the value of bread produced was $10 worth, the value of cheese is $20 worth, so total amount produced is $30 worth in the year 2000. Okay, let's switch to another color. Okay, so in 2001, bread became $2 and cheese became $4, but you produced the same amount. Okay, so what would be the nominal GDP in 2001? It would be $20 worth of bread, $40 worth of cheese, which would indicate $60. Okay, so nominal GDP is current price times current quantity. Price times quantity. Okay, so in 2001, it would be the price in 2001 times the quantity in 2001. Okay, added up for all the goods. And in 2000, it would be the price in the year 2000 times the quantity in the year 2000. Okay, and then if we want to look at the change, the rate of change in nominal GDP from 2000 to 2001, it would be 60 minus 30 divided by 30 times 100. New minus old divided by old. That's always how we calculate the rate of change. Times 100. Okay, so in this case it would be 100% increase. But the problem is that if you're trying to figure out how many more jobs the economy created, so in this case you see the economy produced 10 units of each, and that didn't change. So really it didn't create any more jobs, even though when I looked at nominal GDP, it says that the nominal GDP increased by 100%. Okay, so how do I measure GDP in a way that controls for the price changes? Because you see the reason that the GDP doubled, okay, is not because I actually produced more, but because the price has doubled. Okay, so realize the way we're measuring nominal GDP is price times quantity, that means that if I have a change in price, that'll change nominal GDP. If I have a change in quantity, that'll change nominal GDP. So when I see a change in nominal GDP, I can't tell if it's because of a change in price or quantity or both. Okay, so that's where real GDP comes in. Okay, so real GDP says, okay, I need the prices in order to assign a value to the quantity. Okay, but the problem is that when the prices are changing, it's also driving a change in the GDP, and I want to control that. So what I can do is choose a base year. So let's say 2000 is the base year, okay? And I'm going to use the prices from that year for every year thereafter, okay? In other words, what I'm trying to do is I'm going to say, here's bread, here's cheese, okay? The price in the year 2000, that's my base year. It's $1, $2, and the quantity is 10 and 10, okay? And in the year 2002, okay, I'm not going to use the price from 2002. I'm going to use the price from 2000. So I'm going to hold the price constant. So I'm going to use price is $1, $2, and the quantity is 10 and 10. So guess what? In the base year, what's the real GDP? You got 10 and 20, so you got $30 worth of real GDP, which is the same as the nominal, because whenever you're in the base year, nominal and real are the same. In the other year, right? So I'm using the original prices. So I have $10, I have $20, so it ends up being $30. Whoa, so basically what we're saying is if you're holding the prices constant, in this particular example, you see the economy didn't grow at all. Okay, so that's what real GDP is. Real GDP, it calculates GDP using prices from the base year that you choose. And remember, for the base year itself, nominal and real are the same. Okay. 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 The GDP deflator, now remember, since the nominal GDP is price times quantity, right? The real GDP is like some kind of fixed price times quantity. So what happens if I divide the nominal by the real? The quantity falls out, and what I end up with is a measure of how much price has changed relative to the baseline, okay? And this is what we call the GDP deflator. So the GDP deflator is nominal GDP divided by real GDP, and it is a measure of the price level in the economy, which we can use to calculate inflation. Okay, so for example, if I have GDP deflator in 1 year, let's say the GDP deflator, so by the way, it's nominal times real times 100, right? Nominal divided by real times 100. So let's say the GDP deflator in the year 2005 and 2006. Let's say the GDP deflator is 105, and here it's 110. So what happened to inflation? Well, we could say that the price level went from 105 to 110. So the inflation rate is 110 minus 105 divided by 105 times 100. That would be a measure of the inflation rate. So in other words, the GDP deflator is one measure of the price level. Okay? GDP per capita is GDP divided by the population. Okay? This is a better measure of the size of your GDP, because if you're comparing, for example, China to Puerto Rico, obviously China is a bigger country, it has a bigger GDP. But if you're comparing, a better way to compare it is to look at GDP per person. Okay, so that's GDP per capita. Okay. Moving on to unemployment concepts. The labor force is all the people who can and want to work. Okay, so anybody who, the labor force is anybody out of the adult, non-institutional population, okay, how many people can and want to work, right? So the adult non-institutional population clearly doesn't include anybody under the age of 15. It doesn't include anybody in mental institution or in prison or in the army, okay? The labor force participation rate is what fraction of labor force divided by the adult non-institutional population, right? So what fraction of the people who, they're adults and they're not in jail, whatever, what fraction of them can and want to work, okay? Now, the unemployment rate. Now, by the way, the labor force. So if you are an adult, you're not in an institution, and you can and want to work, right? So there's two possibilities for you. Either you're employed or you're unemployed. Okay, if you add up the employed and the unemployed, you end up with the labor force. So the unemployment rate is employed divided by employed plus unemployed. Okay, or in other words, it's the number of people who are working divided by the labor force. Okay, all right. Now, let's keep moving. So, we said the labor force consists of people who can work, so they're not disabled severely, and they want to work. How do we gauge that? Well, we survey them and we ask them, do you have a job? If they say yes, then they're employed. If they say no, then we say, well, have you looked for work in the last 4 weeks? If they've looked for work in the last 4 weeks and haven't found it, then they're unemployed. If they have not looked for work in the last 4 weeks, they're not even part of the labor force, because we say if you haven't been looking in the last 4 weeks, that means you don't really want to work, okay? But you can have a situation where the economy is so poor, like let's say somebody's been unemployed for a year and then they get just depressed and they give up and they stop looking. Okay, this person, if you give them a job, they would love it. They would totally do the job, okay? But because they're depressed, they're not looking. So officially, they show up as if they're out of the labor force. But in reality, they're not a standard out of the labor force person. They're a discouraged worker. Okay, so how does discouraged workers make a difference? Well, let's say you had a situation where the labor force was 100 people, okay? And out of those 100 people, okay, 70 were working and 30 were not working. Okay, so what's the unemployment rate? So in this case, the unemployment rate is it's the 30 people who are not working divided by the 100, okay? So that's 30%, okay? Now, let's say that out of these 30 people who don't have a job, 10 of them decide to stop looking for a job, okay? So now, unfortunately, the labor force, because they're no longer looking, they're not considered part of the labor force, so the labor force now drops down to 90 because these 10 people stopped looking for work, so they're considered out of the labor force. And the number of people employed is still 70, but the number of people unemployed is now 20 because the 10 people who stopped looking, they're not considered unemployed, they're not considered part of the labor force at all. So what happens to the unemployment rate? The unemployment rate is now 20 out of 90. Which, let's see, it's 22%, okay? So what you see is that with discouraged workers, when there are enough people who quit the labor force because they stopped looking, it actually makes the unemployment rate look like it got better when in fact it's not. It's not the case, okay? All right, what do we mean by underemployed? Underemployed people are people who are working fewer hours than they care to. Like, let's say even if I'm working 1 hour, I'm considered employed. So let's say I would love to work more, but I can't find a job with more hours, so I'm considered underemployed, okay? Different types of unemployment. We have frictional unemployment. This is the type of unemployment that is normal when people go from job to job, okay? Why would people go from job to job? Either you don't like where you're working, you're looking for a better fit, or the job where you were working, they went out of business because they were doing things just inefficiently. Okay, that's frictional. Structural is when there is not enough demand for the kind of job that you do. Either because of technology, maybe what you do is no longer in demand because there's a new technology that put you out of work, or maybe your job was shipped to China, so there's no more demand for you, Or because, if you recall, let's say that I have the number of workers and the wage, right? Remember we said we have a demand for workers, we have a supply for workers. In equilibrium, the demand and the supply are equal to each other. For some reason, if the wage is higher than equilibrium, you're going to have the quantity demanded less than the quantity supplied, so you're going to have structural unemployment. Why would it be that the wage is higher than equilibrium? Maybe because the government implements a minimum wage. Maybe because there's a union that's negotiating higher wages than equilibrium. Maybe because of something we call efficiency wages. That's when firms pay you more than you're worth because they want to avoid you quitting, because it's very costly for them if you quit. So any of these things lead to a situation where the quantity of workers demanded is less than the quantity supplied, which results in structural unemployment. Either way, structural and frictional unemployment are considered normal part of a functioning economy. If you add up these two, you get the natural rate of unemployment. Okay? The bad unemployment is the cyclical unemployment. That's the unemployment that happens when there's a recession. Okay? And when the recession goes away, it goes away. So when we're talking about minimizing unemployment, we're really talking about eliminating this guy. Okay? The natural rate, probably somewhere between 5%. It's around 5%, let's say. Okay? All right. Real versus nominal wages. Nominal wage is what you get paid. That's what's on your checkbook, or that's what's on your paycheck. Okay? Real wage is how much the nominal wage can buy with that money, right? So it's your nominal wage divided by the price level, right? So in other words, if I'm making $100 and I live in New York, that's worth a lot less than if I'm making $100 and I live in Mexico, right? Because the price level is different. So the real wage takes your nominal wage, divides by the price level. Okay? And so it's similar to the whole real GDP versus nominal GDP, right? Real GDP is correcting for changes in prices. Okay? All right, inflation rate is the rate of change in prices. If the price level increased, that's inflation. If the price level decreased, that's deflation. When inflation rate falls, that's disinflation. Okay? What are the costs of inflation? We talked about different costs associated with high inflation. For example, shoe leather costs, that's when people are wasting time avoiding having cash in their pocket, because when cash is in their pocket, the money is losing value because of inflation. Okay? Menu costs is when people have to change prices all the time because of inflation. Unit of account costs is when money's value is changing because of inflation, so it's not a reliable measure of the value of things. Okay? So those are three costs associated with inflation. And then the bigger issue is unexpected inflation. Okay? Why? Because what happens when there's inflation is that the price level is increasing. Okay? Now, people care about their real wages more than their nominal wages, right? So let's say that the nominal wage, let's say the prices go up by 10%. Now, people are going to ask for a raise. They're going to say, listen, prices are going up, you have to pay us more. So if nominal wages go up by 10% to catch up to inflation, then the real wage isn't moving, so people don't care, right? And so as long as nominal wages are adjusting to inflation, it's fine. Okay. Problem is that usually people don't adjust their wages every day, right? Usually people, they sign a contract with their employer for like a year, and until the end of the year is up, you can't renegotiate your wage. So you could say, okay, well, let's say that you're about to sign a contract with your employer. You're going to try to predict what inflation is going to be, and if you predict it correctly, then you're through the contract, you're going to have your wage adjust up. Okay, the problem is that when people don't expect inflation correctly, so then the nominal wage doesn't catch up to the price. And so, for example, if the wage only goes up by 2% and inflation goes up by 10%, then the real wage falls. Okay, so that's one way that unexpected inflation hurts people. Another way is that banks lend money. Okay, and when banks are lending money, they charge you a nominal interest rate. Okay, now, the thing is, let's say that I charge you, let's say I lend you $100, and at the end of the year, you pay me back $100 plus whatever interest. Okay, let's say I lent you $100 and I'm charging you 10% interest, so you're going to pay me back 110. Okay, now the problem is that if inflation came and if inflation rose, then the $110 you're paying me back is worth less than 110. So I'm losing. The lender is losing, right? Now, if I'm in the business of lending money, so then I want to correct for that. So when I charge a nominal interest rate, the nominal interest rate I'm charging is going to be equal to whatever is the real interest rate I want to make, meaning my profit, plus my expected inflation. Okay? Now, if I expect inflation correctly, then I'm not hurt. Nobody's hurt by inflation. If inflation turns out to be higher, so for example, let's say that I charge 10% because I was figuring that I'm going to make an 8% rate of return and because I'm expecting inflation to be 2. Okay? Now, let's say inflation turns out to be 5%. Guess what? I can't go back to the guy and say, I got to charge you more because 10% is on the loan. So what happens is my profit gets squeezed down to 5%. So when inflation is higher than expected, the lenders lose. When inflation is less than expected, the borrowers win. Okay? I'm sorry, when inflation is less than expected, the lenders win and the borrowers lose. Okay? All right. How do we measure the price level? Okay, we kept talking about the price level. We mentioned one way to measure the price level is with the GDP deflator, which is nominal divided by real GDP times 100. Another way is with the CPI. CPI basically looks at a basket of goods that people typically purchase. Okay, so let's say you say, you know what, on a regular basis, I buy bread, cheese, and water. Okay. So I say, okay, I'm going to look at the price and the quantity. So you say, okay, normally I buy 10 pieces of bread, 2 pieces of cheese, and 20 waters. Okay, so in the year 2000, the price of bread is $1, cheese is $2, and water is $1. Okay, so what's the value of this basket that I'm consuming? 10, 4, 20, so 34. Okay, so in the year 2001, now I'm interested in the changes in price. I don't want a change in quantity. So I'm going to hold quantity constant in the base year. So I'm going to say, let's assume the quantity is always going to remain 10, 2, and 20. And now, if I find out in 2001, the price of bread is 2, the price of cheese is 3, and the price of water is still 1. So then the value of the basket in 2001 is 26 and 20, that's 46. Okay? So by comparing the value of the basket over time, that's how I can measure the price level. The problem is that in order to make this pretty, what I do is for the base year, so this is the base year. Okay? The CPI in the base year is going to be 34 divided by 34 times 100. So the CPI is going to be 100. For 2001, it's going to be 46 divided by 34 times 100, okay, which is equal to 46 divided by 46 divided by 34 times 100 is 135. So if you look up CPI numbers, okay, we're going to have the year 2000, you're going to have the year 2001, so here it's going to be 100, here it's 35. So you say, what's the inflation rate? Well, you say it's 135 minus 100 divided by 100 times 100, which works out to 35%. Okay? We have other indicators of price level. So the CPI includes a certain subset of goods that the typical consumer buys. We have the producer price index, which follows the prices of a subset of goods that the typical producer buys. And then, of course, we have the GDP deflator. Okay? marginal propensity to consume, okay, when you have disposable income, the change in consumption divided by the change in disposable income. That's your marginal propensity to consume. Your marginal propensity to save is the change in savings divided by the change in disposable income. It's also equal to 1 minus the MPC. So if you add up the MPC and the MPS, you end up with 1. Okay, so in other words, the marginal propensity to consume says out of each dollar you take home, how much do you consume? The marginal propensity to save, out of each dollar you take home, how much do you save? And obviously, disposable income, you can do two things with it. Either you buy things or you save. Okay, that's why MPS and MPC equals to 1. Okay, the spending multiplier says okay, if let's say demand is $1, income is $1, and supply is $1. If I increase how much I buy by $1, so now the producer is going to say, oh, okay, there's more demand for my product. I'm going to go and produce another $1's worth of product. But in order to do that, I have to hire people, and that creates income worth $1. Okay? Now, the person who got the job producing this extra good has $1 in their pocket. They're going to go and they're going to spend some of that money, right? How much of it? Well, let's say it's the MPC. Let's say the MPC is 50%. So they're going to go and spend 50 cents. That's going to create another 50 cents worth. That's going to create another 50 cents worth of money in somebody else's pocket. They're going to go and spend half of that, right? Assuming at each stage the MPC is half, okay? In other words, whenever you're spending more money, it creates a whole cascade of more money being spent, okay? So that's the multiplier process. The multiplier process says that is equal to 1 over 1 minus the MPC. It says that if I spend an extra $1 in the economy, the size of the economy, the GDP, will grow by $1 times the multiplier. Okay? What about the tax multiplier? Okay? The tax multiplier is actually equal to MPC divided by 1 minus the MPC, which is smaller than the spending multiplier. Okay, I'm going to stop here, and I'm going to make another video with the rest of the terms separately.